Hi, I'm Tim Cantrell. I'm the Principal Investment Advisor and Certified Financial Planner here at Applied Capital, Nashville, Tennessee. Well, we all pay taxes, but very few people actually understand the federal tax code. The tax code is tens of thousands of pages and it seemingly becomes more complex every year. As financial planners, we utilize software to help us evaluate tax returns and run projections of future tax obligations. However, you can successfully run some estimates manually if you understand the basics of how we're taxed. Please refer to the PDF supplement that we have attached to this video. The supplement contains key numbers for the 2024 tax year. Federal income taxes can be divided into three main categories: FICA, ordinary income, and capital gains. Think of the first type, FICA, as a flat tax. It is 15.3% of your income up to the Social Security wage base of $168,600 for 2024. 15.3% is the total amount. Half is paid by the employer and the other half is paid by the employee. So if you're self-employed, you pay both halves, a total of 15.3%. Otherwise, it is a flat tax of 7.65% of your W-2 income up to the Social Security wage base. It is important to note, while the flat tax is a fixed percentage, the Social Security wage base is indexed for inflation, so the $168,600 amount increases annually. When you exceed the annual wage base, the Social Security component of FICA goes away. So during the year when you receive your W-2, the 6.2% Social Security amount stops. Feels like you've received a mid-year raise. If you're self-employed, both the employer and the employee component stop, so the 12.4% goes away, which results in an even bigger mid-year raise. Please note, however, that the Medicare component of the FICA tax continues. It does not go away. FICA applies solely to earned income. So if you receive a W-2 at the end of the year, all or most of what appears on your paycheck stub is earned income and is subject to FICA tax. This includes income contributed to a pre-tax retirement account. This also means that when you draw from a retirement account, you do not pay FICA taxes. Generally, FICA does not apply to dividends or other types of investment income. Short-term capital gains and non-qualified dividends fall into this category. While it is taxed at ordinary income tax rates, it's not considered to be earned income, so it's not subject to FICA taxes. The second tax category is ordinary income. This is what most people think of when you mention income taxes. While income taxes can be very complicated to calculate, it's helpful to understand some of the basics, the first of which is the standard deduction. While you can itemize deductions, most filers utilize the standard deduction. In 2024, the standard deduction for a couple filing jointly is $29,200. The standard deduction is indexed for inflation and can be increased slightly under some situations, including when one or both of the filers is age 65 or older. Alternatively, you can itemize your deductions. However, to make it worthwhile, you must have enough itemized deductions to exceed your standard deduction. It's important to note that while making charitable contributions may be considered deductible, if you do not itemize, the contribution may not lower your tax obligation. So if you're interested or if you're making charitable contributions, please reference our video on tax-efficient charitable contribution methods. Either way, your standard deduction or itemized deductions are effectively a 0% income tax bracket. If your ordinary income is within this range, your ordinary income tax rate is 0 or possibly negative if a tax credit applies. If your ordinary income is higher than your deduction amount for the year, then a progressive tax table of rates applies to the income. Progressive refers to the increasing percentage tax rates as your income increases. As you can see in 2024, the federal income tax rate table starts at 10% and increases to 37%. Each band of income is taxed according to the applicable bracket, so your effective tax rate is a blend of all of the applicable brackets. Depending upon your income, your average income tax rate can be very different than your marginal tax rate. The marginal tax rate is the percentage rate that applies to the last dollar earned. It is the percentage used to determine whether you should make a pre- or post-tax contribution to a retirement account. For more information, refer to our video on making retirement account contributions. Usually tax rates are steady from year to year. The dollar brackets are indexed for inflation, so generally if your income is moving up at the rate of inflation, your average income tax and marginal tax rates will stay the same. However, if your income is moving up faster than the rate of inflation, then your average tax rate and possibly your marginal tax rates are increasing. The change in tax brackets can impact your financial plan recommendations, so it does require reviewing and reassessing your plan on a regular basis. This brings us to the third type of taxable income, long-term capital gains. Capital gains are derived from the sale of an asset for a net gain. If the asset was held for a year or less, it is considered a short-term capital gain. If it was held for over a year, it is treated as a long-term capital gain. Short-term capital gains are taxed at ordinary income, so it adds to your income previously discussed. Long-term capital gains are taxed completely differently. There's a separate tax table that applies, and the underlying tax obligation is calculated after you calculate your ordinary income tax. For example, if you hold shares of Apple outside of a retirement account, then when you sell the stock, you will recognize a gain or loss. If you held the stock for a year or less, then the gain or loss will be considered short term. If you held the Apple stock for 1 year and a day, then the long-term capital gain tax rates apply. The long-term capital gain rates are 0%, 15%, and 20%. If you're married filing jointly, the 0% rate applies up to $94,050 plus the standard deduction of $29,200. So if your combined ordinary income plus capital gains is less than $123,250, then your long-term capital gain tax rate may be 0%. While strange, the 0% is important since you are considered as being taxed on the income, even though it is 0%, you have effectively reset the basis to a higher level and will not be taxed on those funds at a later date. This concept presents many planning opportunities under the right circumstances. Either way, the long-term capital gain tax rates are consistently lower than the ordinary income tax rates across all income categories. So it is always important to note the time in which you held your investment and to delay the sale if you're able to obtain better tax treatment. I have seen investors sell real estate in the 11th month of holding a property, only to incur a much higher ordinary income tax rate on the gain, while waiting a few extra days to close would have allowed the gain to be categorized as a long-term capital gain, leading to a substantially lower tax bill. So please always take note of the holding period for your investment outside of retirement accounts. You should also note that the types of taxes mentioned above are all federal taxes. Depending upon where you live, you may be subject to state taxes as well. State tax rates and methodologies vary by state, so those rates, if any, should be taken into consideration. As a disclaimer, there are exceptions layered upon exceptions in the tax code, so it's always helpful to check with a tax professional to review your individual circumstances. I hope this helps. Feel free to reach out to us if you have any questions.